So if you're watching the financial markets right now, and I mean really watching, especially how Wall Street's traditional giants and the whole digital asset space are interacting,
Mhm.
you're seeing one of the biggest head-scratching divergences in years.
It's a huge divergence.
Yeah.
And it brings up a major question.
It does. And that brings us right to the core question for anyone interested in this space. Really, what is the real outlook for Bitcoin in 2026?
It's a conflict for the ages, really.
Mm.
On one side, you have, these institutional analysts making these unbelievably bold, optimistic forecasts.
Right. And they're driven by what they see as fundamental structural change.
Exactly. But then on the other side, you have Bitcoin's own history, its own rhythm.
It's deeply ingrained cycles.
And that history is whispering a completely different story, a much more cautious tale.
So our mission today for this deep dive is to really unpack these conflicting signals we're finding in the source material you've pulled together.
Right.
We need to go beyond just the headline price targets and really dig into the underlying forces here. It's this powerful investment thesis, the one built on institutional adoption, versus the sobering truth of what these past halving cycles suggest might be coming next.
And that conflict, it's not theoretical. It's already playing out right now. Just look at the numbers year to date.
They're pretty stark.
The S&P 500 has had a tremendous run. It's up, 15%?
Yeah, 15%. And meanwhile, Bitcoin has actually declined 5%.
A 5% decline. That is a divergence we just can't ignore.
No, you can't. It means, and this is the first time in over a decade, that Bitcoin is decoupling from that broader, risk-on feeling in the stock market.
So is this it? Is this the sign that Bitcoin is finally behaving less like a volatile risk asset and more like, I don't know, an independent stare of value?
Or is it just the normal noise we see after a peak?
Well, historically, that specific pattern, the S&P rising while Bitcoin falls, it's only happened once before.
Right, back in 2014.
Exactly, 2014. And that precedent is precisely what's fueling so much of this, extreme optimism for 2026.
Because what happened the next year is the key part of the story.
It is. If you look at the following year, 2015, the S&P 500 basically went nowhere. It
Wow.
traded sideways, offered very little return.
But Bitcoin.
But Bitcoin, after a really tough 2014, it absolutely soared, rewarded investors with a 38% gain.
And that historical rebound, that gives a really powerful narrative hook for the bulls.
A very powerful one.
Okay, so let's unpack that narrative first. This is segment one, the bullish case, all driven by these high targets and institutional drivers.
Yeah.
I mean, what kind of numbers are we actually seeing? Because they are truly enormous.
Oh, they're not shy about it. We're talking about massive, massive implicit upsides.
So who are we talking about?
Key analysts like Jeff Kendrick at Standard Chartered and Gautam Chugani over at Bernstein, they're both predicting Bitcoin will hit $150,000 in 2026.
$150,000. Okay, let's just pause on that. Considering the current price is sitting around, what, $86,000?
Roughly, yeah.
That implies a staggering 74% upside next year.
It does. But here's the really interesting detail from the sources.
What's that?
Those ambitious $150,000 targets, they're actually downward revisions from what they were saying before.
You're kidding. So even after they've adjusted for, current market headwinds and a bit of a cool down, they still see that incredible floor.
Exactly. And, 2026 is just the appetizer for their long-term thesis.
Right. This isn't just a one-year play for them.
Not at all. These analysts, they justify this institutional interest not just on the next 12 months, but on the entire decade ahead.
Okay, so give me the really big numbers.
Kendrick estimates a stunning $500,000 by 2030.
Wow, that's a 480% upside.
In Chugani, he sees Bitcoin potentially hitting $1 million by 2033.
$1 million? That's a 1,060% gain. I mean, when you put figures like that up on a wall, the question isn't just how much, it's why. What is the core investment thesis that leads these highly reputable firms to forecast $1 million asset?
It really boils down to a fundamental shift. A shift in perception and, more importantly, in capital allocation.
So we're moving past the old narrative.
Way past it. We're moving past retail speculation and, that early adopter enthusiasm. The why now centers on increasing sustained demand from major institutional investors.
The big money.
The biggest money. They're actively diversifying portfolios, and you have large corporations integrating digital assets into their treasury strategies. This is the serious capital finally moving.
And the sources are, I mean, they're crystal clear that the single biggest enabler for this institutional rush is the simplified access from the spot ETFs.
Absolutely. The spot Bitcoin ETFs are the ultimate on-ramp. I mean, think about it historically. Buying Bitcoin for a big firm meant complex custody solutions, managing all these different accounts, dealing with high exchange fees.
A huge compliance headache.
A massive one. The ETFs, they just eliminate all of that.
Yeah.
Investors can now get exposure through their existing trusted brokerage accounts. It makes Bitcoin an almost entirely mainstream regulated product.
Okay, but hang on. We keep hearing about these spot ETFs and this promise of a tidal wave of capital. But haven't the flows actually slowed down recently? Or been a bit volatile?
That's a fair point.
I mean, is the hype maybe outpacing the actual current adoption rate?
It's a fair challenge. The flows have been volatile, yes, but the structural adoption underneath all that noise is undeniable. The data shows institutional confidence is growing exponentially.
Okay, what does the data say?
For example, the number of large asset managers reporting positions in the iShares Bitcoin Trust,
That's the biggest one, right?
the largest spot Bitcoin ETF,
Yeah.
That number increased by 150% in the past year alone.
150%.
They're building positions. And if you look at corporate treasuries, the amount of Bitcoin held by public and private companies rose 60%.
Yeah.
So this shows that corporate integration is a serious strategy. It's not a fad.
Okay, so the foundation is being built, and that builds on the ETFs, which leads to the second major enabler for this whole bull thesis, which the sources call regulatory clarity. If the analysts feel so certain about this, why is this recent legislative movement such a huge deal for institutional compliance departments?
It's huge because before this, ambiguity was the enemy. It just choked participation. Institutions need clear rules of the road to operate.
Right.
So back in July, the U.S. House approved the Clarity Act.
And what does that do specifically?
It clarifies whether a digital asset is a commodity or a security. Now, if you're a large asset manager, not knowing which regulator, the SEC or the CFTC, has jurisdiction over your asset, well, that's an existential risk.
A compliance nightmare.
Exactly. Removing that ambiguity is a massive green light for, frankly, trillions of dollars to feel comfortable entering the market, especially with Senate approval expected in 2026.
And that wasn't the only move either. Congress also passed the Genius Act in July.
Right, which creates a new regulatory framework specifically for stablecoins.
And even though stablecoins aren't Bitcoin, they're like the circulatory system of the whole digital asset economy.
That's a great way to put it. Stablecoins are the dollar equivalent inside the digital system. So regulating them doesn't just benefit the tokens themselves, it stabilizes the entire ecosystem. It tells institutions that the government is actively building the financial rails they need.
It's creating a safe, operational, and legal environment for the major players to come in.
That's it.
So we have this unified structural bull case. I think I was State Street Investment Management, who noted institutions are embracing Bitcoin for its diversification, long-term growth, and improving regulatory clarity.
All the institutional boxes are getting checked.
Right. So structurally, everything looks positive for a major 2026 move toward that $150,000 target.
It does.
And it's a big but. Now we have to shift gears completely and look at the source material's counterargument. If structural adoption is so compelling, why does history keep throwing up this massive red flag?
This is where we have to be critical.
Let's dive into segment 2, the sobering reality and what the data tells us about the past.
And this is where that critical thinking is paramount. We have to weigh these powerful new forces, the institutional money, the regulation, against these deep-seated cyclical patterns that have governed Bitcoin's price since day one.
And for 2026, those two narratives are just not aligned.
They're fundamentally misaligned.
So tell us about the halving cycle pattern. For those who might be newer to this, we know it's predictable, but what's the actual mechanism that creates that predictable lag?
Okay, so the halving happens roughly every 4 years, and it instantly cuts the supply of new Bitcoin being mined in half.
The last one was April 2024.
April 2024, correct. Now, the predictable pattern isn't that the price spikes immediately. That almost never happens.
Right.
Instead, the market typically takes time, we're talking 12 to 18 months, to fully price in the massive shock of scarcity that this supply cut creates.
So the mechanism is a kind of delayed reaction. The supply is cut instantly, but the market's psychological and financial reaction, that takes over a year to reach its peak.
Exactly. The typical price peak occurs 12 to 18 months following the halving event. But here's the crucial part for 2026.
What's that?
After that peak, The price then typically enters a long, drawn-out bear phase. It falls over the next 12 to 18 months as people take profits before it finally recovers and begins that slow climb to the next halving.
That paints a very different picture for 2026 than the analysts predicting a 74% upside.
A completely different picture.
So if we apply that historical pattern to the current cycle, where does that put us?
Well, given the last halving was April 2024, the historical sweet spot for the peak is late 2025.
Okay.
The source material actually suggests a potential peak of around $125,000 in October 2025. That's nearly 18 months later.
And the implication of that for you, the person listening, is pretty sobering.
It is. If history holds true, Bitcoin is set to decline, maybe significantly, throughout late 2026 and into early 2027.
Before it begins that multi-year recovery toward the fifth halving in mid-2028.
That's the historical pattern.
So, okay, let's just lay this out. On one hand, you have analysts projecting a $150,000 price, implying massive gains for 2026.
Right.
On the other hand, history suggests 2026 is the year we should be expecting the painful correction, the decline after the bull market peak.
It's a fundamental difference in timing.
It is. And there's a second historical reason to be cautious about next year, right? And it's tied specifically to bear markets, regardless of the halving cycle itself.
Yes, and this statistic is, it's equally stark.
This is the one that I found truly arresting in the source analysis.
It's a very simple metric, but it's powerful. Bitcoin closed in bear market territory, which is defined as being down 20% from its recent bull market high in November 2025.
Boy.
This 20% threshold has been breached 7 times since 2021, and if you look at the 6 previous incidents.
Following those last 6 times that Bitcoin hit that 20% bear market line, what was the average return over the next year?
The average return over the following 12 months was exactly 0%. A full year of grinding sideways or even down. So you have this structural bull thesis driven by massive future demand, and yet history just screams that in the year immediately following the peak and that bear market trigger, lackluster or zero returns are the statistical average.
That is a phenomenal synthesis of 2 completely contradictory data-driven narratives. It puts the investor in a perfect spot of uncertainty.
It really does.
Okay, let's move to segment 3 and try to synthesize these opposing forces. We have this friction between structural growth, the ETFs, regulation, corporate adoption, and the cyclical gravity, right? The halving pattern, that 0% historical average return.
And the main takeaway from the source material really just reinforces this tension. Wall Street analysts are exceptionally optimistic, and it's based on this fundamental shift, from institutional adoption.
Right.
But history, based on the halving cycle and that 20% bear market data, is strongly suggesting that 2026 is a year where those lackluster sideways returns are entirely possible.
Oh, rack as the post-halving correction phase just plays itself out. So the core risk here isn't necessarily that the long-term targets, the $500,000 and the $1 million, are wrong. It's that the timeline is going to be far more volatile and painful than the analyst hype suggests.
Precisely. And this brings us to the critical warning the source material offers to you, the listener. Because when you look at those long-term targets, you have to be prepared for the journey.
And what is that simple but, I think, crucial piece of advice?
It's this. If you are an investor who is uncomfortable with holding Bitcoin for several, potentially extremely volatile years with significant drawdowns, then you should never buy it in the first place.
Plain and simple.
You have to understand that even if those million-dollar targets are eventually correct, the path to get there is not a smooth 45-degree angle. It will almost certainly involve significant near-term turbulence, potentially in 2026, if history is any guide.
Which means the investor today is truly standing on a battleground. You're essentially betting on which force is stronger.
You are.
Is it the gravitational pull of the historical cycles? The old physics of Bitcoin, so to speak? Or is it the disruptive power of all this new institutional money and regulatory certainty?
It forces you to decide if the financial landscape has fundamentally changed enough to override a decade of pricing history. That institutional adoption is the new variable. It's the one thing history hasn't accounted for before.
That was a deep dive that truly delivered conflicting truths. I mean, we've laid out both the massive upside potential and the historical downside risk.
On one side, Wall Street promising a 74% upside for 2026. On the other, the bear market data suggesting an average return of 0%.
And we know the structural drivers are real. The simplification from the spot ETFs, the undeniable increase in corporate and institutional holdings, and legislative progress from the Clarity Act and the Genius Act.
All of which de-risks the asset for major capital.
So, Here is the final provocative thought for you to chew on. Given this profound conflict in the data, the historical cycles pointing to a significant 2026 decline, and the regulatory environment improving so dramatically, are institutional investors simply ignoring the cautionary tales of history?
Or is this the very first cycle where simplified adoption and full regulatory approval finally provide enough structural demand to override the cyclical, supply-driven pattern that has governed Bitcoin's price since its inception?
It's a question of whether structural adoption changes the physics of the asset.
And the answer to that will determine if 2026 is a boom or a bust year, something to consider as you process this deep dive.
We'll leave you with that. Until the next deep dive, stay informed.